John Loos. Thank you for being with us, John. So for buyers or for homeowners, I guess the main thing in today's speech was that interest rates not going up now, but likely, very likely in the future.
Yeah. Look, that was the Reserve Bank's model, which they run. It's an where they endogenize, as they call it, the repo rate, and based on how they project for economic fundamentals ahead, you could see interest rates rising, but that will depend on, and the MPC will use its discretion. But yes, if you look at the world's economy growing fairly strongly, oil prices going up, significant rand risks, I think it's always prudent to, when you're in the home investment business, wherever you are with interest rates, you should be able to absorb a few percentage points worth of hikes as a prudent measure. If you can't, do something, fixed rates, or think again about that house you buy.
I was going to say, what does it mean for buyers? Fixed rates, or at least know you can handle those a few rate hikes, at least 1%, I guess.
No, that's the thing, either or. I mean, I never recommend to people they should fix rates, but if you're near the edge and you get offered a nice fixed rate at some point, it can be worth your while to sleep easily for 5 years or so, up to 5 years, knowing that your rate is fixed. But other than that, I mean, personally, I haven't fixed a rate myself, but you've always got to have some buffer, and you've got to know that your cash flows are right for some reasonable amount of interest rate hiking, because death taxes and interest rates do go up at some point. That's a given.
So historically, our rates aren't very high, are they? And that's not what's holding buying back, because the market isn't flying either.
No, what's been holding buying back. Firstly, go back to 2008, and you had a very high debt to disposable income ratio after that property boom, bubble if you want to call it that. So the household sector, when rates came down after 2008, most of them just breathed a sigh of relief. It didn't give a huge stimulus to the market. And we're still gradually bringing that debt to disposable income ratio down, with borrowing growth that's slower than disposable income growth. There are a lot of concerns as well. The economy is not firing. People do feel it. Job prospects aren't that good anymore, and income growth is under pressure. So consumer confidence indices show very low readings. The household sector has become more cautious. You've seen it in some rise in the savings rate. And I think it's not only about the banks lending conservatively. I think it's about a lot of households wanting to, suppose, as they call it, deleverage to bring their debt ratio down. And I think that will continue over the next number of years in this very uncertain socio and political environment, is that you will see a more financially cautious household sector. Not necessarily good for boosting housing demand in the near term, but it's almost got to happen. Lower debt levels and higher savings rates are a very healthy development.
So it's not only rating agencies watching the political uncertainties and the Reserve Bank, but individual homeowners as well.
I think so too. And especially on the more affluent side, I think people are cautious. People are nervous about where is the future going. And I say that because if you look at consumer confidence readings recently, the financial situation, that part of the consumer confidence survey wasn't that bad. What came through was when they asked people, where do you see this economy over the next few years? And there was big concern about that. So it really seems to be about future concerns that are driving confidence low.
So the upshot is, you look at the rate at which house prices are rising. So in October, prices were going up, but below inflation. So in real terms, as a homeowner, your property is losing actually a little bit of value.
Yes, so we had a 4.1% year-on-year house price growth rate. For the year to date, the average year-on-year rate is just above 3%. That's probably going to be lower than last year's annual average, and inflation nearer to 5%. So you're getting a real house price correction. You had some real house price correction last year. And yes, that's a reflection of these weak economic times. You've still got relatively high real house prices as a hangover from the boom. So our house price levels, I would say, more reflect still those days of 5% plus economic growth prior to 2008. They haven't fully corrected downwards, but now with the sustained economic mediocrity, if you could call it that real house price correction is starting again.
And I was interested in Cape Town, because we know there on the Atlantic seaboard, I mean, price growth has been off the charts.
Crazy.
But is it finally coming back to some sort of semblance of normality or reality?
It does seem like it. Our overall Western Cape house price index is now near to 5% year on year, so it's not that double digits that it was a year and a half ago. And our sub-regional indices for the Atlantic Seaboard, the City Bowl, those really high growth ones, they're all slowing. They're still high, but they have been slowing year-on-year growth rates. So it seems that finally housing affordability has caught up with the Western Cape. First-time buyers are really struggling to afford homes there, and ultimately it's got to be a self-correcting thing. You can't just have prices rising and rising. Affordability does become a challenge eventually for more and more people, and it seems that way. I think outside Cape Town, in the smaller towns, it could be that the drought is starting to get to their economy as well and to the market.
And generally it seems like there are trends, so let me test one with you because you've got the numbers. Are you paying a bit of a premium if you live in a complex with a lot of security? Are house prices becoming cheaper because of that security issue?
Yes, if you look at sectional titles, we know a lot of them are in cluster complexes, and that provides it provides better use of land, makes it more affordable in a way, and it also provides perceived better security than a lot of normal full title suburban areas. And you have seen that sectional title house price inflation slightly above full title in recent times, but how much that's got to do with security and how much it's just got to do with affordability,
and lifestyle,
it's difficult to say.
Lock up and go.
Yes, but I do think clusters are often perceived as more secure, and that adds to their growing popularity, I think.
All right, we're running out of time. What does it mean, if anything, for homeowners if we are downgraded? Sort of how does the real economy affect your investment?
Well, downgrades can affect capital flows in and out of the country, investment into the country. So you can get a weakening of your rand if they go downgrade more than the market expects. That can impose inflationary pressure, and that can lead to interest rate hikes. That's the most obvious way that it can affect that credit-driven part anyway of housing demand. The lack of investment flows as well curbs your economic growth, and any curbing of economic growth curbs job creation, curbs household income growth, and affects demand that way. So ratings downgrades can't be good. There might be some people who still believe in this this weak rand that can be good, but I don't buy that. It just can't be. It can't be a positive, I don't think.
All right, thank you so much for your analysis, John Loos from FNB, property economist.